Last week, we justified agent commissions, hopefully. This week, we're going to make the case for whole life and IUL together. Why you should own both. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with NetWealth Finance.
All right, making the case for whole life and IUL together. I have a client that looks at this as core and explore. Whole life insurance as the core part of your savings efforts, and explore where we get better loan opportunities and good growth opportunities along with that. It doesn't affect the growth in our policies when we're using the cash value in the IUL. And I just thought that was really cool. But tell me what you think. What is your base case for whole life and IUL working together?
Well, it really connects to what you just said. And I think that the whole life as a whole can really serve as a good savings mechanism and have that solid, consistent growth over time. And that IUL, I really like having the loan structures, especially in the product that we prefer. Really great indexed loan, participating loan options, and you have that higher growth potential. So I really look at it the same way. I think one way that I like to think about it is if somebody's really thinking they're going to want to get both, I like to determine what does their current asset outlook look like. Do they have a lot of money in the stock market and maybe nothing allocated to a safer instrument like CDs or bonds? Maybe that's where I might think about whole life first. And various other scenarios might lean toward IUL first. And so I think there's really a lot of different ways that you could go with this.
Yeah, you do need to start somewhere, and that is often a conversation I have with my clients, which one to get first. And we will generally look at what type of overall risk do you currently have in your finances. If you're into high risk things, whether it's the stock market or maybe almost all of your risk is in a business that you own and all of your extra money is going into there, and so you don't have savings built up on the side and you keep reinvesting into that. Like that's pretty high risk. Whole life can pair very good with that. Whereas other people are just very comfortable with having their risk based on index growth, and what the IUL has to offer is really attractive to that type of person. So where we start at may vary depending on the person. But ultimately, I think that there's a case to be made that says there's a lot of value in whole life that when you get the chance to save money, and everybody should have some type of money they set off for savings. This is money you're not generally going to touch, whether it's emergency funds or just, pay yourself first. We put that into a whole life policy. When you put extra money into a whole life policy, you're buying paid up additions, which immediately turns into a multiple of death benefit. So when you're younger, you might get 3 or 4 times immediately in death benefit the money that you put into it. It can even be greater than that, depends on how old you are. Whereas in the IUL, you put that money into the IUL and it turns into, at best, the exact same amount of death benefit. So case in point, 10,000 goes into whole life. You now have an extra $40,000 death benefit or 50,000 death benefit. You put 10,000 extra into an IUL, you got 10,000 extra in death benefit. So there's a case to be made that if an accident were to happen a few days after you bundle this money away, it was clearly better off going into the whole life policy and working over there just because you get that death benefit multiple. And then, of course, we get all the savings to go along with that.
I think that's a really good way to think about it as well. And it actually, in my overall outlook of things and how I was planning with my own whole life policy, I was thinking about it in that way too, and seeing that growth over time of that death benefit significantly more, especially in these early years that I have those paid up additions turning into a good amount of death benefit. So I think that's a really powerful thing and really good call out. And it's actually one of the reasons why I did start with my whole life policy. And also that connects to this idea of it's just going to be a solid return over time. Whole life carriers that we use have been paying dividends through various interest rate environments, and they've had strong returns, not massive returns, but strong returns, solid, safe returns for a very long time. And I think that's a really good reason for having whole life in your asset portfolio.
Yeah, so the case for whole life is a good place to just set money aside. You don't necessarily want to touch it, but you can. It's certainly liquid. And when we do the optimized designs that we like to do, you have the opportunity to use that money while you're still alive if you need to go do other things, to go do other investments, take advantage of other opportunities. The IUL represents something a little bit different. When we do an optimized design, we may not know what the growth is going to be in any given year. It could be zero, could be 1% if we have that type of a guarantee in that type of a policy, but we can design it to where the expenses could be like 0.1% of the value that we're storing in that policy. And to me, having the ability to create that kind of a policy that we can have millions of dollars in and still have the opportunity for 10, 20 plus percent returns is incredible and no loss. That no risk of loss in that policy. In a 0 year, we just go backwards by that 0.1%. That's an incredible tool, especially when we can borrow against that at a very high rate, not have to worry about margin calls, and we don't have to worry about affecting the growth in the policy. Like that is some amazing opportunities that we have available in the IUL that we don't get from the whole life side.
And personally, that's why when I'm going to look to take a loan, the first place I'm looking is at my IUL, because I'm not impacting that growth. In my IUL, I have a fixed rate, 5% that I can borrow against without impacting that growth. I do have the other option of being a wash type of loan, but really, in my mind, the power of that IUL is that potential for arbitrage. So in my head, I'm always thinking about this like, I've got a 5% cost to borrow. If I get arbitrage on top of that, great. If it's a bad year and I don't fully cover that 5% in the crediting on those same funds, then I'm paying 5%. Just like most people in this market right now, you can't even get mortgages for that amount. So it really is a powerful thing to have those good loan structures and uninterrupted compounding at the same time.
Now, I have 13 policies among myself and the family members. And this is where the power of having options comes in. And this is ultimately the case for whole life and IUL. I have whole life policies that are direct recognition. That means if you borrow against them, the dividend rate will be adjusted. And right now, that dividend rate will be adjusted lower. So the impact when I borrow against those policies is going to be that I'm going to have a reduced amount coming in from dividends if I borrow against it. I also have whole life policies that are non-direct recognition. I borrow against that policy and it doesn't affect the dividend growth. But the rate that I can borrow against that is 5.82% right now. In the direct recognition, I can borrow at 5.76. In my IULs, I have a couple of different carriers and I can borrow at 5% fixed forever for the life of that policy. And then in my other IUL, I'm currently at like 4.5% that I'm borrowing from, but the maximum they could possibly charge me is 6%. Those are good options. And when I need to borrow money, I have different choices that I can go to first. But among all those that I just listed, what would be the first one that you go to? It would be one of the IULs because that's a more attractive option. And ultimately, when we look 20 years down the road and we've built up a lot of money in our whole life and money in our IULs, we like to have that flexibility where if I need money, I'm going to go to wherever it's going to cost me less. And because I took the time to build up whole life and IUL, I've got good options to choose from.
Yeah, and I think that that's another thing. Calling out, having all those different options, having a couple of different places you can look, it just adds to your toolkit, whatever that might be. And when if you're an investor, let's say you're a real estate investor, you might have a few different hard money lenders that you work with, different lenders, not necessarily hard money, all the different lenders. You might work with a bunch of different lenders in order to have the ability to tap one in certain circumstances or another, or even pit them against each other to have them bid, whatever it might be. And that's kind of what you can do when you have a couple of different products or more, as in James's case, where he's got so many different options. You have this ability to tap whatever the best source is. And when you have both IUL and whole life, you've got some really great options. But at the same time, there could be other options. Maybe, having both of those things can open the door to where you might also take some kind of securities-based line of credit against your brokerage, because you always have the ability to replenish that. So having the different options, knowing that you can quickly get funds from either one of these things, and that's the other thing too, is different carriers will tend to average to slightly different amounts of time, how fast you get the money, the ease of the technology or whatever it might be to request those funds. So that is another thing to consider when you're looking at these different policies, is how does the carrier operate in terms of accessing those funds?
Yeah, the ease of taking the loans will certainly impact which one I choose to borrow from, depending on how long I need to get the money out for. I do find that I will tend to go to the easier one first. And they're not all created equal. I think in the long run, though, we do plan to own these things for many, many decades. And all of these carriers will move into the 21st century technologically, and they should all end up being very easy to borrow from. Currently, some of them are just a little bit harder than others. But when I say harder, that means maybe it takes just a couple of extra steps.
I certainly wouldn't decide on a policy based on those factors, but when looking at my own policies, it's just the same. I will think, oh, this might be a little bit easier, so I'm gonna go with this one instead for now. And but in the end, that's why it's really powerful having different options. And I think for various reasons that we've covered here, it's powerful having both whole life and IUL. And even if you're starting off small, that might be one way to go about it, is start off with some small policies, one on each side. But it really depends. So I think that's where a real conversation is going to make sense, because it's not the scenario is not going to be the same for everybody as to whether or not you should get two small policies, one from a whole life, or one is a whole life policy, one is an IUL, versus maybe just starting with one big policy and waiting a year for the next one or something like that. Really takes a conversation to understand your circumstances.
Yeah, each situation is going to be different. I think at the base level, we can design whole life policies to be optimized at a much lower level than the IUL, at least with our top IUL products. With our top IUL products, you can put a lot of money into those when they're at that optimized level. And I wouldn't recommend buying more than one policy unless you're already maxing out one of those policies. And ideally, we're going to max out both of them if we're looking to set up two policies at the beginning. A lot of that is going to just come down to, what is your funding plan? What are you anticipating to do with these things? And that is going to take a conversation with a knowledgeable agent. We would be more than happy to help any of our listeners out with this stuff. You can see how to contact us in the description. And I think that would be a good call to action for our listeners this week. Anything else to add?
No, I think that's about it. Yeah, get in touch with us if you're interested in having a conversation about this.
Be sure to join us next week, where we go over wash loans versus participating loans. It's the arbitrage debate. I'm James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance, and we'll work with life insurance clients across the country as well.
Take care. See you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.